What if I told you the stock market already knows everything? Everything. Stay with me for the next 4 minutes and I'll reveal why some of the smartest minds in finance believe markets are basically crystal balls. But first, let me ask you something. Have you ever wondered why your carefully researched stock picks sometimes perform worse than throwing darts at a board? Welcome to Omniverse Network, where we decode the mysteries of finance. Today, we're diving deep into the efficient market hypothesis. Picture this. It's the 1960s. The world of finance is a gentleman's club, dominated by the belief that with enough research and a little bit of genius, you could consistently pick winning stocks and get rich. It was a treasure hunt. But over at the University of Chicago, a young economist named Eugene Fama was about to publish a paper that would essentially call the whole treasure hunt a myth. Fama proposed something so radical, it bordered on heresy. He called it the efficient market hypothesis. The core idea? The stock market is an incredibly efficient information processing machine. He argued that at any given moment, stock prices aren't just random numbers. They are the collective, weighted average of every hope, fear, and piece of analysis from millions of investors worldwide. In essence, the price already reflects all publicly available information, making it nearly impossible to consistently find undervalued stocks and beat the market. Let's make this real. Think about a huge company like Apple. In the days leading up to an earnings announcement, there's a buzz of speculation. Analysts make predictions, traders place their bets. Now Apple announces earnings that are way better than anyone expected. What happens to the stock price? It doesn't drift up over a week, it jumps, almost instantly. Why? Because in the milliseconds after that news hits the wire, millions of traders, hedge fund managers, and hyper-sophisticated computer algorithms all pounce on it simultaneously. They buy, and the price adjusts to a new equilibrium that reflects this positive surprise. By the time you read the headline, the opportunity is gone. The market has already priced it in. This powerful idea isn't just one size fits all, it gets even more nuanced and controversial. Fama and others broke the efficient market hypothesis down into 3 distinct forms, or flavors. Each one makes a bolder claim than the last, and understanding the differences is crucial, because it could fundamentally change how you approach investing. First up is the weak form. This is the most widely accepted version. It states that all past market data, like historical prices and trading volumes, is already baked into the current price. This means that looking for patterns in charts, a practice known as technical analysis, is a fool's errand. The next price move is essentially a random walk, unpredictable from past moves. Sorry, chartists. Next, we have the semi-strong form. This is where things get more heated. It claims that prices don't just reflect past data, but publicly available information. This includes everything from earnings reports and balance sheets to news articles, economic forecasts, and even political developments. This form directly challenges fundamental analysis, the idea that you can study a company's health to find its true value. The theory says by the time you've done your homework, the market already knows. Finally, there's the strong form, the most extreme and controversial of all. It posits that stock prices reflect information, public-private. Yes, that includes secret insider information. This version suggests that even a CEO with knowledge of a secret merger couldn't consistently profit from it. Now, most experts agree this form doesn't hold up in reality. The very existence of laws against insider trading, and the fact that people go to jail for it, proves that private information can indeed be very profitable, if illegal. So, is your mind spinning yet? If the market is so efficient, does that mean we should all just give up? Not exactly, but it does raise a huge question. If beating the market is so hard, what's the smart way to invest? But what if I told you there are still ways smart investors use this knowledge to their advantage? And what if some of the world's most successful investors openly disagree with this theory? I'm looking at you, Warren Buffett. But first, let me give you 3 practical tips that work whether you believe in market efficiency or not. Here we go. Alright, let's get practical. If the efficient market hypothesis tells us we can't consistently outsmart the market, what's the smart move? Tip number 1. Diversify like your financial future depends on it. Because it does. Since you can't reliably pick the winning stocks, the logical strategy is to own a little bit of everything. This isn't admitting defeat, it's playing the odds intelligently. Spreading your investments is your primary defense against unpredictability. Think of it in layers. First, diversify across asset classes, a mix of stocks for growth and bonds for stability. Then, diversify those classes. For stocks, spread your money across various sectors like tech, healthcare, and energy. When one zigs, another might zag, smoothing out your ride. Finally, diversify geographically. By including international and emerging markets, you tap into global growth and reduce home country risk. A classic starting point is the 60/40 portfolio, but this isn't a rigid rule. Your personal allocation must be tailored to your age, goals, and risk tolerance. Tip number 2. Keep your costs lower than a limbo bar. High fees are the silent killers of investment returns. If the EMH is correct and most active managers can't beat the market, why pay them a premium for trying? Their fees come directly out of your pocket, win or lose. This is the most powerful takeaway from the theory. While you can't guarantee higher returns, you guarantee lower costs. It's the one variable completely in your control. A 1% difference in fees might seem trivial, but over 30 years, compounding can turn that small fee into a massive loss of potential growth. So what's the solution? Low-cost index funds or ETFs? These funds don't try to pick winners, they simply aim to replicate a market index like the S&P 500. Because there's no expensive team of analysts, their fees are dramatically lower. Look for funds with expense ratios well below 0.1%. Your future self will thank you. And that brings us to our final crucial tip. Tip number 3. Time the market beats the market. If markets are efficient, trying to predict the peaks and valleys is a fool's errand. You have to be right twice, when to sell high and when to buy back in low. The odds are stacked against you. In fact, the market's best days often happen right after its worst. Missing just a handful of those rebound days can devastate your long-term growth. Studies show missing the 10 best days of the S&P 500 over 20 years could cut your returns in half. The antidote is a simple, powerful strategy: dollar-cost averaging. This means investing a fixed amount of money at regular intervals, no matter what the headlines are screaming. When the market is down, your money buys more shares. When it's up, it buys fewer. This removes the single biggest threat to your portfolio, your own emotions, forcing you to buy low and stay invested for the long haul. Now, here's where things get spicy. Not everyone buys into the efficient market hypothesis. While it's an elegant academic theory, in the real world, it runs into a multi-trillion-dollar problem: us. The counter-argument is compelling, and it's championed by some of the greatest investors in history. Take Warren Buffett and Peter Lynch. They've consistently beaten the market for decades, and their entire philosophy is built on the idea that markets are often inefficient. Their strategy, value investing, involves actively hunting for fantastic companies that the market has temporarily undervalued due to short-term panic or neglect. They believe the market makes emotional mistakes, and their job is to capitalize on them. If markets were perfectly efficient, their life's work would be impossible. This leads us to the fascinating field of behavioral finance. It argues that markets aren't driven by cold, hard data alone, but by a cocktail of human emotions and cognitive biases. We're prone to herd mentality, buying stocks just because they're popular. We suffer from loss aversion, holding on to losing stocks far too long because the pain of realizing a loss feels too great. This emotional decision-making, the classic battle between fear and greed, creates pockets of irrationality, and the evidence is written in the dramatic charts of history. How does the EMH explain the dot-com bubble, when companies with no profits were valued at billions? Or the 2008 financial crisis, fueled by a housing bubble that many assumed would never pop? These weren't rational markets. They were markets gripped by what Alan Greenspan famously called irrational exuberance, followed by sheer panic. So here's the big question for you. Do you believe the market is an efficient crystal ball where all information is perfectly priced in? Or is it an emotional roller coaster driven by human psychology, creating opportunities for those who keep a level head? Drop your thoughts in the comments below. I read every single one. If this video helped you understand one of finance's most important theories, smash that subscribe button and ring the notification bell. Because every week, Omniverse Network breaks down complex financial concepts into digestible, actionable insights that can actually improve your investment decisions. Next week, we're diving into options trading strategies that even beginners can understand. Until then, keep learning, keep investing, and remember, knowledge is your best investment.